We've got the February 2023 real estate stats here for Lafayette Parish, live and in person. But before we jump in, we always do pride ourselves in bringing you real time, up to the minute data so you can make an informed decision on your house. So moving forward, I'm doing something a little bit different. We're going to go and show some graphs, and I'll help you kind of interpret what a lot of these numbers mean. They're a little bit of the matrix that are popping in, but you'll be able to follow along from the numbers where we can kind of see what's going on here. So without further ado, of course, this is always with Market Scope, Bill Bakke, our oracle for all things real estate. So we'll be able to go and explain some of these things right here. So Lafayette Parish. The blue line represents 2023, red line represents 2022. So obviously we got a pretty big gap between January and February. Positive news, we had upward movement from January to February. So contrary to all of the craziness going on via media and interest rates being in the 6s and 7s, market activity is actually picking up. Now we're kind of comparing apples and basketballs here, because beginning of the year, actually most of the year last year up until June, July, we were dealing with 2s, 3s, 4s, and 5s as far as the interest rates were concerned whenever we were jumping in and comparing some of these numbers. So what I've always gone and talked about was, how do we compare to what the last normal time used to look like? So when we talk about some of these numbers, we had a 41% difference between February over February sales. We jumped up, like I said, 17% compared to this year to date this time last year. I'm sorry, moved up 17% from January of last month. So things are moving up. Year to date, we're down 45%, 702 versus 386. So down at the bottom, how do we compare to what we were in years past? 2021, obviously another big COVID year, 37.5%. 2020, this is a ramp up because we had some pretty low rates right here. January and February were normally one of the slower months, but 19, which is what I've been preaching for months and months and months, was the last normal year. So we were down 6% compared to total number of homes sold in 2019. So we're kind of hovering back down to normal. And again, we're comparing these numbers, 386 versus 411. The difference is 6%. Time on market is up from 29 days on the market up to 61. Again, not necessarily a surprise. Benchmark numbers for neutral market is 180. So still well below what neutral markets happen to run. When we look at dollar volume, same story. We had a nice uptick as far as dollar volume. This is everything in MLS, all companies, all firms out in the greater Lafayette Parish area, all the sales that were reported over to MLS. So 97 million compared to 61.5 million. That represents 36.5% decrease from February over February. It's a 31% increase from last month. So things are actually moving up, even with the higher rates that we are fighting. Again, we're comparing 2.5%, 3% interest rates for February, and we're going to see a similar trend. We're going and fighting against record-breaking numbers, and it just wasn't sustainable. Year to date, down 42.5%. Strangely enough, while we're hearing Chicken Little and the sky is falling, if you look right here, $281,509. That compares to last year's $269,081. Our average sales prices actually went up by 4.5%. Median sales price went up 2%. So what does it look like when we're comparing previous years? 2021 down 28%. If you look at 2019, we're actually up 23%. So we're hearing, the sky's falling, everybody's dropping prices and this, that, and the other. List to sales price ratio, which is what the home is listed at versus what the home closes at, is down it went from 98.27% to 97.74%, which is about a half a percentage point, which is exactly a half a percentage point. And if we're looking at comparing it to a $200,000 sale, you're talking about a whole $1,000 difference in the total number of concessions or drop in sales price. So we're not seeing drastic amounts of price drops that are there. The ones that are showing up in your feed from Zillow and Realtor.com and whatever your search engine happens to be, those are sellers that have been stretching the market, trying to go and adjust, We're just, once they come in line, typically there's not a really big gap between what's offered and what's sold, statistically speaking. Pending sales. This is going to be one of our leading indicators of what's going to happen moving forward. So we do see a drop in the total number of pending sales, but again, keeping in track with the trend, we were up from January 250 to 285. When we compare it to February of 2022, we're down 16%, down 27.5% from year to date, year over year. So down a little bit, 27%. Again, we're competing against some of these higher rates, but healthy progress moving forward. I won't go jump in on the pending sales. Supply. So this is the other end of the equation. How many homes are coming on the market when we have a whole bunch of these coming off the market? Now, we were down in the total number of pending sales, down 27%. Year to date, we're down 31% year to date on the total of new homes coming on the market. So what that means is there are fewer homes coming on the market than there are coming off the market, which is further dropping the supply or available choice of homes for you, the consumer, to be able to go and find. So when there's limited amount of supply, less likely to see drastic price drops, which supports the discussion of our average price point is actually coming up about 4.5%. Moving forward, again, down 31%. So what does that mean from a total number of homes that are actually on the market? I'm going to pull up, this is all properties. And while this looks a little bit like the matrix, all homes sold is going to be in this quadrant here. Total number of active listings are in this quadrant right here. This is the total number of months supply, also known as absorption rate. How many months will it take the number of the active listings to move into the number of sold categories, assuming nothing new showed up on the market? Now, don't have a ton of things going under 150, but what we do see is quite a bit of activity. All these numbers, when we talked about before, anything less than 6 ends up being a neutral market. Anything over 6 is going to be favored towards the buyers. Anything less than 6 ends up favoring the sellers. Now, you'll see some pretty big numbers in the 500 moving down. Typically speaking, these numbers, all of them are going to be a little bit skewed for the first couple of months because we only have a handful of sales versus all of the inventory that we did previous years. So one sale is going to actually end up cutting 550, it turns this 21, it's going to drop this down drastically, almost in half. So while we still have a pretty good size amount of homes to be able to choose from, 21 homes for sale in the 500 to 550 with 2 closed, that doesn't count any of the ones that are currently under contract. So some of these numbers are going to drop. This particular number of months supply, we do expect that to be able to drop down some. So interest rates. We're seeing interest rates running right at 6.875 for a 30-year fixed, 6.375 for a 15-year fixed, and government is floating right at 6.5. We've had some very good news over the last few days. Jobs report was very favorable for us. The inflation report was very favorable for us. So we actually saw a dip down in the rates from, lower 7, 7.25, 7.3 down to 6.8. So things are kind of ticking down. May 10th is one of those numbers that we are waiting to see for one of the reports. We should see some relief on some of those interest rates moving forward. So what does that mean? If we're running into, if we're going to be catching some lower interest rates, we still have very limited amount of inventory. So one of the things we want to be able to do, where's the bottom? So right now we're at the kind of the tip top, coming close to the bottom, and bottom's probably a different word to be able to use because the interest rates are peaking. But when those things peak, they're going to start to end up dropping. So right now, we're running into sellers that are a little less confident about the sales price of their home. So there's also skepticism running around with buyers right now because they're worried about interest rates being here forever. Good news, none of these things ever last forever. The great markets never last forever. The bad markets never last forever. So this is going to be just ebbs and flows of what's happening, kind of the day of the life of what we deal with as real estate agents. So this graph basically talks about the seller being a little bit more fearful for less competition with buyers, and rightfully so. We saw the total number of pendings coming down, but we do have the total number of listings moving down as well. So before it ends up popping up, we're having sellers that are wiggling a little bit more than what we've had in the past. So what you're selling in is also the market you're buying in. So when you're buying, you've also got that ability to be able to do so on the home that you're moving forward. So what does that look like? Whenever that ends up popping up, we're going to see another uptick in our pending sales, which means fewer inventory, fewer homes that are going to be coming, because we're already very depressed in the total amount of homes that are currently on the market. That's going to drop even further, which is going to increase seller confidence and tighten up those purse strings from the sellers, because there's nothing to be able to choose from. So what happened last time we had a bottom cycle? January 2012. This is national numbers too, just so everybody knows. There was an 8% appreciation year over year after the bottom, even with 2.5 million or 2.4 million homes in inventory. We saw a big jump. We went from 137-ish all the way up to 145 in January 13. So January 12, it was pretty quick. Happened in a year. We could see something very similar to this moving forward in 2023, 2024. Another graph that ends up showing the same thing. 2.5 million in inventory. Today we have less. We almost have a little more than a third of that available inventory. So we have fewer things to be able to choose from. So chances are we're going to see a kick up. I'm sorry, that number is going to drop even further when the rates do drop. So what does that mean to you as a borrower? Let's say you got a home that is $500,000 that you're taking a look at. You're going to be putting 20% down, or $100,000. Rates are, instead of 6, they're at 7, or instead of 5.875, they're at 6.875. That monthly increase for the $400,000 30-year fixed is $257, which equates to a yearly increase of $3,084, almost a mortgage payment for some folks. Where the opportunity runs is we're having sellers that are going to be discounting a little bit more than what they normally do. So let's just say, just on the conservative end, let's say they drop it by 2%. That's $10,000. 500,000 times 2% equals $10,000. When the prices rise as the rates decline, we're anticipating a 3% estimate. Remember, we had an 8% estimate in this. We had 8% appreciation in this last bottom cycle. So we're being extremely conservative when we're taking a look at what that happens to look like. So less than half. That $15,000 goes right back to you in appreciation. The cost for refinances, whether it's, re-pulling title, new appraisals, any other fees that are attached to that, that's a $5,000 cost. The net dollar to you is $20,000. So, again, we hear this is the next crash. Rates are never going to be able to come back up. Everybody's going to be losing their houses. Let me show you why the difference, that we're not going to run into prices dropping as drastically as they have in the past. This particular report, again, from Bill at Bill Bakke at Market Scope. So thank you guys for these visuals for everybody to be able to see. Tough to be able to tell, but 1985 right here, we have 7,874 homes that were currently on the market. Let me go. 7,784 homes that were on the market, and we had roughly 1,896 homes that sold. So about a 6 to 7 to 1 ratio of homes available versus homes available versus homes sold. Fast forward over to 2022, we had fewer homes available for sale, 7,388 than we did in 85, but we had 6,300 homes, a little over 6,300 homes sell that year, closer to 1-to-1, like 1.1, 1.2 to 1. Much tighter ratio compared to what we've seen in the past. So unless we end up seeing 50,000 homes or 10,000 homes end up jumping up, actually more than that, 50,000 if you want to get to the 7-to-1 ratio, we're not going to run into prices, free falling like they did in the 80s. So the myth of things falling apart is absolutely false. The opportunity, however, is here to be able to grab a better price. Just got to ride the wave a little bit. And we've got some programs to be able to keep those costs down with 2-1 buy downs and all that stuff. So what does that happen to look like to you from an equity position? We'd love to give you we'd love to chat with you and see what that happens to look like. Feel free to reach out to me via direct message, or you can catch me on my personal cell, 337-658-5690. Thanks so much for joining us. We'll see you next time.